If you want to get the best rate on your next mortgage, then you need to know how to control the conversation with your lender. More specifically, how to negotiate so good that walking out with the lowest rate feels almost unfair. My name is Francisco. I've closed over 400 loans, approved more than $200 million in mortgage financing, and saved my clients over $500,000 in interest by giving them the lowest rate their file could possibly qualify for. And in the next 10 minutes, I'm gonna break down the exact playbook I use to negotiate the lowest possible rate on a mortgage so you can walk into any lender and lock in the best deal your file qualifies for. Now, before we get into how to negotiate, we need to understand one thing first. What even is negotiation? And to put it simply, negotiation is just leverage. But what is leverage? Leverage is having something the other person wants or needs, which gives you the power to set the terms. So let's say you and a friend are trying to decide where to grab dinner, and you're the one with the car. You have leverage because they're getting in your car, either way, and going where you want to go. Now, if you don't really care where you eat and they have a car too, you have zero leverage and you're probably going wherever they want. It's the exact same thing with a mortgage. The rate you walk out with isn't decided at the table when you sit down with the lender. It's decided by how much leverage you walked in with. So there are 5 things you can use to create the kind of leverage that allows you to negotiate the lowest possible rate, even if it's your first mortgage. Starting with number 1, having an alternative. This is something I learned years ago, watching the best clients I worked with negotiate their own file, and it's the foundation everything else is built on. Now, this doesn't need a huge explanation because it's very straightforward. Basically, if you walk into a lender without any other options, they know it. And if they know that, why would they give you their best rate? They already know you're signing with them no matter what. But the moment you have a better offer from another lender in your hand, now the lender is the one who has to do the convincing because now they know they have something to lose. And if they don't give you a better rate, they lose a deal to whoever else quoted you. That's leverage. Freddie Mac actually ran a study on this and found that buyers who get one extra quote save around $1,500 over the life of their loan. And buyers who get 5 save closer to $3,000 just from making a few phone calls. So the way you do this is very simple. You get 3 quotes from 3 different lenders, a bank, a direct lender, and a broker. Then you take the best one and you bring it to whoever you actually want to work with. That's exactly what one of our clients did just a couple of months ago. Her credit union had her at a 7.125. She was about to sign until her agent called her and told her to call me first. We got her 3 quotes. The best one came back at 6.625%. And when we sent that back to her credit union, they called her the next day with a 6.75. And it's not like they didn't have the rate the whole time. They just weren't going to give it to her until they thought they were losing the deal. And this is the part that most people don't understand about how lenders actually work. Because they never quote you their best rate first. They quote you the rate they think you'll accept, which is almost always higher than what they actually are willing to do. The only way to move them off of that number is to give them a reason to do it. And the easiest reason in the world is a better offer from someone else. Which brings me to number 2. Because once you have an alternative in your hands, the question becomes, how do you actually use it in the conversation? And that's where the next one comes in, anchoring. See, in any negotiation, whoever throws out the first number sets the standard for the whole conversation. So if the lender quotes you 7.25 first, that's the number you're going to spend the rest of the conversation trying to negotiate down from. Maybe you get to 7%, you feel like you won. But the truth is the lender could have given you a 6.75% the entire time. You just never gave them a reason to go there. Now, imagine you walked in with a loan estimate from another lender showing 6.75% before they even said a word. Now, 6.75% is a number they have to beat, not 7.25. And the lender has to come down from your number instead of yours having to come up from theirs. Actually, there's a Nobel Peace Prize winner named Daniel Kahneman who proved this happens to everyone. His research showed that people put way too much weight on the first number they hear, and they have a hard time letting go of it even when they know they should. It's not a personality thing. It's just how the human brain works. And it works on lenders the same way it works on everyone else. And anchoring doesn't just work on interest rate. It works on every single number in the conversation including the fees. Most lenders are going to charge you anywhere between $1,000 and $2,500 in what they call origination fees, which is basically just their cost for processing the loan. And if you let them quote that first, $1,500 sounds completely normal because that's the number they put on the table. But if you walk in saying another lender quoted you with no origination at all, that same $1,500 doesn't sound normal anymore. It sounds like extra, even though nothing about the fee has actually changed. And that's what anchoring does. It changes what counts as a fair price before anyone realizes it happened. Now, once you're actually in the conversation, the next move is to stop letting the lender choose what to show you. Number 3 is asking for 3 quotes instead of 1, but from the same lender. And most buyers don't even know that this is an option. But every lender can quote your loan in different ways depending on something called discount points, which is just a fee that you pay upfront to lower your interest rate. 1 point actually costs you 1% of your loan amount and drops your rate by about 1/4%. So on a $400,000 loan, 1 point can cost you about $4,000 today, and your rate goes from 6.5% to, let's say, 6.25. And the question every buyer asks at this point, is it worth it paying $4,000 to save money on your monthly payment? And the honest answer is, it depends. Because most loan officers won't even run that math for you. They'll just push the quote that sounds the best on the surface, which is usually the lowest rate, without ever telling you what you're actually paying for it. So you have to be the one to ask for all of them. You ask them to show you all 3 versions, the one with no points, the one with 1 point, and the one with 2 points. And now you can actually compare them and figure out which version of the deal makes the most sense for you. But how do you actually compare them? Well, if 1 point costs $4,000 and it saves you $80 a month, you divide the $4,000 by $80 and you get 50 months, which is just over 4 years. So you have to keep that loan for at least 4 years before you've made those $4,000 back. But anything before that, you lost money. And 4 years might sound like nothing, but most homeowners don't actually keep their mortgage anywhere close to that. They either sell, they refinance, they pay it off early, and the average homeowner ends up holding their loan for around 5 to 8 years, which means if your break even on points is more than 5 years, you're spending money today to save money you'll actually never recapture. So the rule I give every client, it's very simple. If the break even is more than 5 years, skip the points and keep the cash, because $4,000 sitting in your bank account does way more for you than $4,000 you spent to save $40 a month on a loan you're going to refinance in the future anyways. Number 4 is realizing that the rate isn't the only thing you can negotiate. See, there are at least a dozen other things on the table, and most of them cost the lender money while costing you nothing. And so, when you only push for a lower rate, the lender only has one way to say no. But the moment you bring in other things into the conversation, you give them multiple ways to say yes. For example, how fast you can close. Most lenders want a 30 to 45 day close, but if you can close in 21 days, that's worth real money to them because they get paid sooner and the rate has less time to move on them. So you offer a faster close in exchange for a better rate, and usually they'll take that trade. Another one is how much down payment you put. Going from 5% to 10% drops your rate, and going from 10 to 20 drops it again and gets rid of your mortgage insurance, which can save you hundreds of dollars a month. Every extra percent you put down lowers the lender's risk, and lower risk equals lower rate. And the biggest one for investors is future business, because if you're planning to buy more properties, you'll have to tell the lender, since suddenly you stop becoming a one-time deal and you become a long-term relationship. And 5 future loans is worth way more to them than 1 closing. So they'll sharpen the pencil on the first one to win the rest. That's exactly what one of my investors did last quarter. He was buying his second rental property in Texas, but he already had 2 more under contract and a plan to close 6 properties over the next 2 years. A retail lender had quoted him 7.5% on a DSCR loan, but we sent his file to wholesale lenders that does volume pricing for investors building portfolios, and we locked him in at a 6.875. Nothing about his file actually changed, but we got a completely different rate because we framed him as the first of 6 deals instead of one isolated transaction. And the way you actually use all of this in a conversation is by trading, not asking. You don't walk in begging for a lower rate. You walk in and tell them what you can offer. A 21-day close, 25% down, more deals coming, and you ask them what rate they can give you for a file like that. So now instead of asking for a discount, you're giving them a reason to compete for your business. And speaking of framing, that's actually number 5, because how you frame yourself with the lender starts deciding your rate before any numbers ever come up. And the way it works is that lenders are constantly trying to figure out what kind of borrower you are within the first 5 minutes of meeting you. A one-time transaction gets priced one way. A long-term relationship gets priced another. And whatever box they put you in, it's the box you stay in for their entire conversation. So you have to set the frame before they do. I had a client last year who runs an e-commerce business, and he had already been turned down by 3 banks before he ever came to me. His tax returns only showed $68,000 in net income because he was writing off everything, even though his business was depositing $35,000 a month into his bank accounts. And every bank that looked at his tax returns, they saw $68,000, and they labeled him risk. But when he came to us, we reframed him as a successful business owner whose tax returns weren't telling the real story. We put him on a bank statement loan that uses actual deposits as proof of income instead of his tax returns. He ended up closing on a $625,000 property at 6.99% with 15% down payment. And that's the thing about framing. It doesn't just decide how lenders price you, but it also decides whether they take you seriously in the first place. Now, those 5 tactics are how you build leverage on offense. But there's one more thing you need to know. Because even when you do everything right, some lenders will still try to slip tricks past you that make their quote look better than it actually is. And if you don't know what to look for, you'll think you got a great deal until the closing table. There are 3 big ones I see all the time. And the first one is hiding the real closing cost. Because when a lender gives you a quote, they only directly charge you for a small piece of the total, which is the origination fees in what's called Section A of the loan estimate. Everything else, from the title, appraisal, taxes, insurance, and recording fees, is a third-party cost the lender doesn't actually charge, but still has to estimate for you. And a sneaky lender will show you only their Section A and bury everything else. So you walk in expecting closing costs of $1,500 and the real number ends up closer to being $8,000. The way around this is simple. You just ask for a full breakdown of every single fee on the quote, not just the lender fees. And if they only show you Section A, you know they're hiding the rest of the bill. The second trick is the same idea, but it's with your monthly payment. Because a real monthly payment includes a lot more than just the loan itself, principal and interest. It also includes property taxes, homeowners insurance, mortgage insurance, and HOA fees if you have those. But some lenders only quote you the loan part, so a payment that looks like $1,800 a month actually ends up being $2,400 once everything else gets added in. Others will quote you the full payment, but lowball the taxes to make it look smaller. And what they don't tell you is that the county is the one who actually decides what your taxes are, not the lender. So the number they put on the quote doesn't actually mean anything once the real bill comes. The fix here is just asking for a full payment breakdown in writing with every line item before you decide anything. And the last one is rate quotes that actually aren't locked in. This one is the most common because a verbal quote means nothing, and neither does an email with an interest rate on it. The only document that actually locks in your interest rate is what's called a loan estimate, and most lenders, they won't even give you one until you're already under contract on a property. So if a lender promises you an interest rate over the phone before you even started shopping, they're just telling you what you want to hear. So you'll sign with them later on. Get every single quote in writing and lock the rate the day you go under contract. Now, knowing the tactics and the tricks is most of the game. But there's one last thing that decides whether any of this works in the first place. And that's where you actually shop. The type of lender you walk into changes what's possible before you even open your mouth. Banks and credit unions are the most rigid because they only have one rate sheet and one set of products, and most of them only sharpen their pencil for high net worth clients with significant deposits. So for everyone else walking through the doors, the rates is just the rate. Retail lenders have more flexibility and a wider product set, but they still only have their own shelf, which means that their loan officer can only put you into what their company already offers. Mortgage brokers like us shop your loan across dozens of wholesale lenders at the same time, which means we're not tied to one rate sheet, and we can actually find the product that fits your file instead of trying to make your file fit a single product. And this matters even more if you're self-employed or you're building a portfolio. Because the product that works for those situations, things like bank statement loans, P&L loans, profit and loss, DSCR loans, those almost never sit on a big bank shelf. The only way to access them is through a broker who works with the wholesale lenders that fund them. So when a bank tells you that you don't qualify, it usually just means that you don't qualify for their products. And a broker working the whole market can usually find a path that the bank couldn't even see. And once you've gone through all of that, you'll walk into any lender with way more leverage than they're used to seeing. And you'll lock in a rate that's actually competitive instead of just whatever they wanted to give you. Now, the rate is just one part of getting a good mortgage. If you want to know how banks specifically take advantage of first-time buyers in ways that have nothing to do with the rate, watch this video next where I break that whole thing down.